Michael Burry, the man who famously predicted the 2008 housing collapse, has returned with a warning that is more precise and more dangerous than anything he's said in a decade. While retail investors are celebrating triple-digit gains in AI stocks, Burry is describing the current market as the scene of the bloody car crash, minutes before it happens. He isn't just talking, he's betting big. Burry has reportedly loaded up on a massive leveraged short position against the semiconductor sector and AI darlings like Nvidia and Palantir. We're talking about January 2027 put options with strike prices so low they imply a catastrophic repricing of the entire tech sector. But why now? Today, we are doing a deep dive into tech valuations and the tragic algebra Burry believes is hiding a $1.7 trillion illusion in corporate earnings. We'll compare today's AI Capex to the 1999 fiber-optic buildout and show you the specific mechanism that Burry believes will cause the AI bubble to pop. The most explosive part of Burry's thesis is his direct comparison of Nvidia to Cisco systems in 1999. Back then, Cisco was the picks and shovels play for the internet. If you wanted to build the new economy, you had to buy Cisco routers. Its revenue was real, its technology was transformative, and yet the stock still fell 80% when the build-out phase ended. Burry argues that Nvidia is currently benefiting from a distorted demand phase. Hyperscalers like Microsoft, Google, Meta, and Amazon are in a frantic AI arms race, committing over $635 billion in capital expenditure for 2026 alone, a massive 70% increase from the previous year. But here's the trap. Burry believes this is merely a training and benchmarking phase that will not last. Just like the fiber optic cables that were overbuilt in 2000, we are creating a bullwhip effect where companies overorder chips out of fear of missing out. Nvidia now has $119 billion in non-cancelable supply commitments with TSMC. If just one major buyer like Microsoft cuts its chip spending by 20%, Nvidia's revenue could take an immediate 4% hit. When the build-out finishes, the Cisco moment arrives and the oversupply of hardware meets a cooling demand. In April 2026, Burry published a 66-page paper called The Tragic Algebra, and it is terrifying for anyone holding a NASDAQ 100 index fund. After auditing 10 years of 10K filings for 97 major tech companies, Burry found a $1.7 trillion gap between reported earnings and true owners' earnings. The culprit? Stock-based compensation, SBC. Wall Street tells you SBC is a non-cash expense and adds it back to profits to create adjusted earnings. But Burry argues this is an illusion because companies must eventually spend real cash to buy back those shares to prevent dilution or pay employee taxes. In his data set, for every dollar of earnings Wall Street reports, shareholders actually only keep about 83 cents. For a specific group Burry calls the tragic tier, which includes Tesla, Palantir, and Shopify, the real cash cost of employee pay has actually exceeded their entire cumulative net income over the last decade. These companies aren't building wealth. They are quietly transferring it from your index fund to their employees. If you think the comparison to 1999 is just a feeling, look at the data. Burry has highlighted 6 key indicators that are currently uncomfortably precise matches to the dot-com peak. In 1999, the Shiller-Cape ratio hit 40 times. In early 2026, it hit 40 times again. In 1999, technology represented 33% of the S&P 500. Today, it is at 32%. Margin debt is at record highs, and hedge funds are as concentrated in tech today as they were then. There's also the technical coiled spring warning. Burry notes that 60% of equity assets are now in passive index funds. This means trillions of dollars flow into these 7 Magnificent Seven stocks automatically, regardless of their price. But when sentiment shifts and investors begin to sell, there is no one making buy decisions on the way down. Everyone sells everything at once, turning a pullback into a violent dislocation. So, if the AI bubble is too big to save, where is Michael Burry putting his own money? While he is shorting the AI hype, his long positions are focused on deeply out-of-favor value plays. He has built positions in names like Mercado Libre, Adobe, PayPal, and retail turnaround stories. His logic is simple. The cheapest things in the world are the ones everyone is afraid of, and the most expensive are the ones everyone loves. Whether Burry is right about the exact timing is the only question that matters. He was early in 2008, and he may be early now. But as he points out, the math of the tragic algebra is not a prediction, it's an audit of real, reported filings. Before you buy the next AI dip, check your portfolio's concentration. Are you investing in a business, or are you just volunteering to be someone else's exit strategy? If you want more deep dives into the principles of value and market history, subscribe to the channel. And remember, wealth is the money you didn't lose in stupid manias. See you in the next one.